talk about Parkinson's law now. So the concept of Parkinson's law is leverages the behavior, the make do with what you got. And I'll share a couple of really good stories about this. But really, if our demand for resources, we increase our supply of it, and that's what we're. And that's why if we're given 2 weeks to complete a project, it will actually take us 2 weeks. If we're given 8 weeks to complete the same project, it will take us 8 weeks to complete that project. The more we put something in front of us, the more we will consume it. This is how humans behave. And so for Parkinson's law, I have a couple of great stories. I have a client who has a hard time savings. He recently got in a auto accident and didn't have proper insurance coverage. And because of this, he needed to fix his truck. He's in construction. He needed $15,000 to fix his truck. Insurance wasn't going to kick in because he had paid for his truck in cash, which was great, but he didn't have the right insurance on the truck. And so within 4 weeks, he said he's never been able to save $15,000 so fast. But because he had 4 weeks to do it and he was out of truck to make money in construction, he got super creative to find that $15,000. He started selling things on OfferUp. He took odd end little jobs. He worked 65-hour weeks to get that $15,000 so that he could get his truck fixed. Meanwhile, he borrowed his friend's truck, which was a rundown old ice cream van, and cops kept pulling him over for that. And so he really quickly wanted to get out of that situation. Well, that's the definition of Parkinson's law. You make do with what you have. If things are really tight, you get innovative and you figure out how to get things done. I know that Mike in his book, Profit First, likes to talk about the tube of toothpaste. So in the beginning of the month, you buy the brand new tube of toothpaste and you're pretty sloppy and generous with the amount of toothpaste that is on your toothbrush. But towards the end of the month, when that tube of toothpaste looks like that on our screen right now, you get really creative. If there's a plop in a sink, you might decide to pick it up with your finger and put it on your toothbrush, or you might cut open the tube to get the last bit of scoop out. And so that is actually the definition of Parkinson's law, right? We're getting creative, frugal, innovative, to make the most of what we have, right? And so we also like talking about sequences, and sequences is how things are presented to us dictate our use of these things. So think about the sequences with going back to our kind of diet example. Veggies are usually eaten last because most of us think vegetables are gross. I'm actually learning to like them now, but actually you should eat vegetables first. They're high in fiber, they fill you up, they're good for you. And so we're telling you to take your profit first, but there is temptation, kind of like the chocolate chip or the Oreo cookies that we talked about. You try and use your willpower, but we all know willpower is much like a muscle and it starts to fatigue, right? The day comes where you can't pay your bills. So what you're going to do is you're going to end up looking at that profit account that you set up for yourself, and you're going to end up transferring the profit over to your operating account to pay your bills. But you can't steal from yourself, right? This defeats the system. And so we're going to be talking about why it's so important that profit first account, a lot of times we recommend that it's even set up at a different bank to make those transfers back and forth almost impossible to do, right? We want to be able to look at our operating account, and when it's tight, we need to make some really, really strong choices and tighten up the belt. Or hustle our butt and figure out new ways to bring more income in, right? That's the two ways. You either spend less or bring more in. And if we just take the easy way out by getting a line of credit or going to our profit first account and borrowing from ourselves our future profit that we're going to be taking, we're defeating the purpose of profit first. It's not about transferring things back and forth. That's not using the system of profit first. That's just making your bookkeeping a nightmare. If something's not accessible, we don't use it, and we revert back to the make do with what you got. So going back to my client and the example with the truck in the shop, he figured out how to get that truck out of the shop as fast as he could. So let's talk about peaks and valleys. One of the things, and this is different and customizable for every client, But in the Profit First book, Mike talks about the 10-25 rule as trigger days. And this is when we actually do our allocations. And so there's two reasons why we do our allocations. The first reason is that bills are normally due on the 1st and 15th. So it gives us those time frames to allocate from our income account to our operating account, and then to pay those bills when they're due. And the second reason is it starts actually forming these wave patterns. So I like to talk about this as, it's summertime. I love summertime. It's my favorite time of year. And a lot of times you put your chair close to the waves so that the waves kind of splash your feet when they come in. And you get to feel this kind of standard norm, right? When the waves are short, you have to pick up your chair and kind of walk it towards the ocean, right? But when the waves are long, you notice this and you pick up your chair and you kind of scoot a little bit back. What do you need to fix? What do you need to replace? This starts forming wave patterns. Maybe there's only 10,000 coming in. Normally it's 25 grand. You start investigating it. What are the red flag moments? Has something changed in marketing? Has Google changed its analytics? Are you not speaking out in the public enough? Maybe you're not taking your referral partners out and telling them what you do best. These are the red flag moments. You can identify these changes in expectations with cash flow. So a lot of times when I meet with clients, and again, this is 92% of the clients we meet with, Kelly and I will say like, wow, you had an amazing year. You made $80,000 more this year than you did last year. How does that feel? What did you do with that money? And the common response is, I didn't even know that. I don't know where that money went. I didn't know I made $80,000 more. Or the opposite. Wow, it was a really tight year. You did a great job managing your budget this year. I noticed you didn't borrow any money, but you made $60,000 less. How did you manage to do that? And again, most of the time the client says, well, I don't really know. I know things were a little bit tight, but I didn't know I made $60,000 less. I guess I just got a little bit more frugal and I learned how to manage the money better. So when we develop these trigger days where we're actually moving money out, you will see it and you'll be able to make adjustments quicker rather than in April when you come to see us, know that you lost money or made more money. And so again, we call these trigger days. The 10 and the 25th is when we move our money. But sometimes people like to move their money weekly. It really depends on the business, and this can be customized. This is a general rule of thumb. And so now we get to talk about profits. So profit account, this is used to celebrate. So again, we like to put our profit accounts at different bank accounts so that we don't borrow and transfer the money back and forth. You don't want to plow back or reinvest it back into your business. You're training yourself just to kick that can down the road if you do this. You're avoiding the call for innovation, efficiency, and frugality. And so that's what we want to do. So I'll share a personal story. Many of you know that we had a very good split from our previous tax firm that we used to work with. And it was just time, visions changed, and it was all good. And so we were doing Profit First over at that tax firm. I met Mike probably about 10 years ago. I was fortunate enough to meet him. Dave Ramsey had him speak on stage at a huge event that I went to for Dave Ramsey. And then Mike took the accountants that were there out to a dinner and started telling him about this concept. And then quickly we became Profit First coaches, certified in it, because we just thought it was a great idea and we wanted to run our accounting firm that way. So we were using Profit First that way and did really, really well. Well, when we broke off from the old tax firm and created Elite Tax Partners, we only did one bank account. It was always the intention to deploy Profit First in our business. But in the beginning, we had 7 weeks. Our plans had changed from the year goal that we had. We had 7 weeks to form the new corporation. We weren't going to be taking over the other one. And so one bank account got formed. And in December the following year, because tax season had been so great, we had profits, but we hadn't separated them out from the bank account. And we threw some big parties for our referral partners, for our, we had a huge celebration for the team. And I kind of forgot about the new tax rule that you could pay your California pass-through entity tax to the company. That was rather large. Our software bill was due, and I kind of forgot about that. That was about 14,000. That was rather large. And there's a couple other odd ends we needed to staff up in January. And so because I, in Elite Tax Partners, wasn't doing Profit First, if I had been doing Profit First, I would have known about that. And I would have been able to tighten our belt a little bit more during November and December to take us through so January wasn't so rough on us. So now we are using Profit First. That was very important to us. We are saving. We've created some extra accounts. One of our goals is to purchase a commercial property in 3.5 years. So we're also creating an account to save for that. So these are just some of the stories of Profit First, why it's so important. I didn't get innovative, efficient, or frugal because I didn't see the wave patterns and I forgot about some hidden bills. I was literally doing what I told clients not to do. I was checking our bank balance and what was in QuickBooks, and I wasn't thinking about upcoming bills.